The Rockefeller Strategy and how whole life insurance creates generational wealth in Canada. Question: why have you heard about the Rockefellers before? Well, the Rockefeller family is synonymous with long-term intergenerational wealth. The company was founded in 1870 by John D. Rockefeller. So Standard Oil established one of the largest fortunes in American history that has withstood economic crashes, world wars, recessions, and generations of tax policy. And so how has this wealth survived for over 150 years while most family fortunes don't make it past 2 or 3 generations? The answer lies in strategic wealth planning, specifically using types of trusts that are funded by whole life insurance. And the approach is actually now called the Rockefeller Strategy, and it ensures that wealth remains in the family and gets passed down tax efficiently and continues to grow over time. So if you're looking for a way to create a lasting financial security for your children, your grandchildren, and even your great-grandchildren, this powerful wealth-building strategy can be applied with some changes and make it work in Canada. So hi, my name is Laurent Munier, and I'm a partner here at Safe Pacific Financial, and we've been helping incorporated Canadian business owners and their families to grow their wealth and to grow their business income for more than 10 years. Now, why is whole life insurance essential to build generational wealth? Many Canadians think of life insurance as a safety net, as a way to ensure that your loved ones received a financial payout if something happens to you. But whole life insurance is so much more than that. Obviously, it does that, but it does much more. It's a very tax-efficient investment vehicle that provides living benefits and liquidity while protecting your family's wealth from unnecessary taxation. And it's something that helps to ensure that your money stays in the family for generations. The Rockefeller Strategy uses whole life insurance, and what it does is it funds a trust that protects assets from taxation. It also provides liquidity to pay estate tax without selling family assets. And it creates an ever-growing financial legacy that never gets depleted. So in Canada, where estate taxes, probate fees, and capital gains can take as much as 50% of an inheritance, this strategy becomes an essential tool for anyone who's serious about preserving their family wealth. Now, how does whole life insurance protect and transfer wealth in Canada? Well, one of the most powerful features of whole life insurance is that it accumulates a tax-deferred cash value inside that the policyholder can borrow against while you're alive. It also passes to your beneficiaries tax-free. So it avoids very costly capital gains tax. It avoids any sort of probate fees. And so how can this Rockefeller strategy, or in Canada, some companies call it a waterfall strategy, how does this work using life insurance? And it's actually pretty simple. Usually it's the grandparent, a parent or grandparent purchases one of these whole life policies on their child or grandchild, and you overfund the policy. That means you put the premiums in plus some additional cash value over many years, and you can build a significant cash value inside the policy. And then the policy can either be transferred to that grandchild when they reach adulthood, and then the grandchild now owns this growing financial asset that can be used for major life expenses. But ideally, you want it on each generation of the family. So the grandparents should have insurance, and then the parents should have insurance, and then the grandkids should have insurance. And if there's great grandkids, you want to do it on each one. Because what this method allows, it allows for this financial asset to be transferred tax-free across generations, and it ensures that the wealth remains in the family instead of going to the CRA. So if you're the grandparent, some of the benefits are you maintain control of the policy until you can transfer it to your kids or to your grandkids. It significantly reduces a tax liability because it shifts the assets into a tax advantage structure, which is the life insurance policy. And you can use and access the policy cash values during your lifetime if you need. And then the benefits, so if you're a grandparent doing this for a grandchild, the benefits for the grandchild is that they receive permanent life insurance, which is basically lifelong protection for them and their family. They can also use the policy cash values for things like education, buying a house, starting a business, investing. Obviously, they're asking you for that. And they get the tax-deferred growth and the tax-free use of this throughout their life for all of these things that they need, whether that's, school up front or retirement towards the end. So as an example, this is an existing example right now. The grandparent contributes about $70,000 to a policy over 5 years. So by the time the grandchild turns 65, the policy is going to have over $1 million of cash inside the policy. And so the grandparents and the parents and the kids are able to use that money throughout their lives. Well, actually, sorry, technically only the grandparent is allowed to do anything, but obviously they're doing it for the benefit of either their kids or their grandkids. Now, what if the grandparent passes away before transferring the policy to the grandkids? Well, the common concern with this is that if the owner passes away before transferring the ownership, the policy may become part of the estate. And then this adds tax complication. So there's a few things you can do here. So number one is you want to name a contingent owner. So this could be either the grandkids' parents or could be the grandkids themselves. If they're minors, then there would be a trustee as well. And this allows the policy to pass tax-free to them, and it ensures that the control stays inside the family. So with the Rockefeller method in the United States, this uses what's called an irrevocable trust. This guarantees that the policy proceeds are reinvested into a trust which secures the wealth for generations. Now, this works a little bit differently in Canada. We don't have these irrevocable trusts with the tax advantages that are set up the exact same way in the US, but there are ways of doing this through either holding companies or through trusts. There's actually specific types of insurance trusts that you can do in Canada. Really, without knowing your exact situation, I couldn't tell you what's a better way to do it. We would have to meet and I see your situation and say, what's a better way for it to happen in your situation? But by structuring the ownership correctly and by placing the policy in the right place, it can remain tax efficient, potentially tax-free, and it can continue to grow without being disrupted for lifetimes. And then how do you build the multi-generational wealth in the way that the Rockefellers did it? So at the heart of the strategy of the Rockefeller method is the concept of the trust or some sort of legal entity that's designed to preserve and to manage the family assets across multiple generations. So now, why does this work for wealth preservations? So by putting it into this, whatever entity is, it prevents the money from being spent irresponsibly. It also ensures that as these life insurance policies pay out, that it pays out into the entity and then is used again to buy more insurance. And then future generations receive the wealth, keep it protected, but it also keeps it all in the family. So a big difference between how people traditionally do inheritance is usually what happens is when like the parents or the grandparents pass away, they give each child some inheritance. So it splits up the family money. And so it fractures it or splinters it, which makes each individual piece smaller. By keeping everything together, you have that core principle from the family stays bigger for longer and it doesn't get frittered away into the generations. As an example here, the grandparent would set this up where they would set up the trust or holding company and they would fund a whole life insurance policy. So the entity then would own the policy and it would ensure that the proceeds remain protected. And then each generation receives the financial benefits while also adding for future family members, right? So for future generations. Then this can be a legacy that never runs out for your family because each generation reinvests, the wealth continues to grow indefinitely, and it allows the family to remain financially independent for generations, just like the Rockefellers are doing today. So here's an easy, simple case study. So we're going to illustrate this over a lifetime, and here's the scenario. So we're going to say that the grandparent puts insurance on a granddaughter, and the granddaughter's 6 years old. And so they make the initial investment over 5 years. And this is our client. They do the investment over 5 years, $70,000 total over this period of time. And we're going to use today's dividend scale interest rate from the insurance company, which is 6.25%. So the face amount of insurance after the 5 years, so the granddaughter, the 6-year-old, is going to have $677,000 of death benefit. So when she passes, if she passed away today, this is what would pay out. And then the policy will be transferred tax-free to the child when the child turns 18. And then we just pick these numbers for, you can transfer it whenever you want. It doesn't have to be 18. So how does this wealth grow over time, right? So say the granddaughter, when she's 18, uses $30,000 of that to fund a university, to go to college, to go to university. So she's borrowing money from the policy to pay for school. For the next 10 years, she's going to pay that $30,000 back, call it a student loan from the family. And then 12 years later, she's 30 years old and she wants to buy a house. So she's going to borrow $60,000 as a down payment, which she's going to also pay back over time. So many, many years later, granddaughter's going to be at a retirement age. So she's going to be 65 years old and she's going to want retirement income. So this will allow her then to also borrow $50,000 a year from the policy for the entire rest of her life to live on during retirement. And then eventually, let's say the 6-year-old granddaughter passes away at 85. So a huge life insurance payout over $1.5 million is going to pay out to her kids. So all of this was done with a $70,000 investment upfront from the grandparents, right? So what happened? Paid for child's university, paid for a down payment on the first house, paid for child's retirement. And these are just three like super obvious life milestones that most Canadians are going to go through, right? And then eventually, actually, when the child dies, insurance pays out to the great grandkids that the grandparents would probably never have even met. So now how do we know, is this Rockefeller strategy right for you? So many Canadian families, business owners, grandparents are now using this type of strategy to secure financial stability for future generations, minimizes estate taxes, and creates a self-sustaining wealth system. Now, like any financial strategy, there are important factors to consider before implementing. And we're going to break down key aspects of the whole life insurance funding, the tax implications, ownership structure, and we want to ensure that you fully understand how to maximize the benefits and also avoid the pitfalls. Firstly, how is the policy funded? And we want to understand a concept called paid-up additions. And so a key component of the strategy is the use of paid-up additions on top of the policy premiums to fund the policy. So what is a paid-up addition? It lets you have faster cash value growth while also increasing the death benefit over time. So what happens is the dividend is used to buy additional insurance, which gets you more insurance, which gets you a higher dividend, which gets you a higher cash value, which the dividend then buys more paid-up additions, which gets you more insurance, which gets you a higher dividend, which, if you're familiar with stock terms, it's like a DRIP, like a dividend reinvestment program, but it's the life insurance version of it. So your cash value is growing and your actual amount of insurance is growing. The cash value grows inside the policy tax-free, and it compounds over time, and it provides a source of liquidity when needed. And it can provide that liquidity in a few different ways, whether you're actually withdrawing or whether you're borrowing against the policy. We have tons of videos on this channel about how to access cash values from your life insurance policy. Then the paid up additions that we're talking about now, they accelerate the policy growth, meaning the 6-year-old, in this case, the grandchild, will inherit a more valuable financial asset in the future than you're setting up today. So now something to consider, because whole life insurance policies in Canada are tax exempt, reinvesting the dividends through the paid up additions is a super efficient and tax-free way to compound growth. And it makes it really important for wealth building over time. Something to watch out for with paid up additions, though, is that some policies could have limits on how much you can overfund in paid up additions each year. But again, that's where you want to work with the right advisor. So you want to work with somebody like us who knows what we're doing so that we can set this thing up so that it matches your needs and that we're not running into limitations that are not planned for and that we don't know about. Secondly, there's tax implications. So how does whole life insurance work with the CRA, or how does it avoid the CRA's excessive tax burdens that we're facing right now? One of the biggest advantages of this Rockefeller strategy is the favorable tax treatment in Canada. So there's no annual tax reporting on these insurance policies unless funds are withdrawn from the policy. So the cash value grows tax-free inside the policy, which is not the same, but similar to a TFSA, but it doesn't have those contribution limits that you have in a TFSA. When this person eventually dies, the death benefit is paid out tax-free to the beneficiaries. So it completely avoids capital gains. And then there's also a few tax considerations that you want to keep in mind. When you're borrowing against the policy, the loan proceeds are not taxed when you're borrowing from a third party like a bank. So this makes this a very tax efficient way to access the fund. You can also borrow from the insurance company tax-free unless you go above something called your adjusted cost base or your ACB. We have tons of videos on policy loans and ACBs, which you can click on YouTube and it'll tell you, or just go on our website, savepacific.com, it's on there. Withdrawals from the policy can also be taxed depending on how much is accumulated in cash, but they're often taxed at a lower rate than RRSP withdrawals. If the policy is properly structured, and if you've got it in some sort of protected entity like a holding company or a trust, it can be protected from a lot of tax and from probate fees. And generally, you're just adding another layer of protection here. So some pitfalls, some things that you want to watch out for. So if the policy holder passes away before transferring the policy, that policy could become part of their estate. And that would trigger probate fees and it could potentially trigger taxes. So to avoid this, you want to make sure you have what's called a contingent owner named on the policy. And that's usually either the parents or it could be the child themselves, but somebody in the family that when the grandparents pass away, the policy transfers to this next person automatically. A lot of the growth here depends on dividends, and are dividends guaranteed? Whole life insurance dividends are a major advantage of this strategy, and they're something that we do count on to help the policy cash value and death benefit to grow over time. And so the dividends historically, and actually right now, are somewhere between 5 and 6% in Canada, depending on the insurance company that you're working with. And the dividends are used to buy the paid up additions that I just talked about, which increases the policy's death benefit, and it allows the policy owners to access additional fund without impacting the core policy. An important consideration is that many of Canada's largest life insurance companies, right? Canada Life, Sun Life, Manulife, Equitable Life, they've been paying dividends consistently into these types of policies for more than 100 years. And that includes through all financial turmoil, like financial crises, Great Depressions, world wars, 2008 financial crash, through COVID. Now, even me saying that they have paid dividends for more than 100 years, I cannot guarantee you that they will pay dividends in the future. But they've never missed a dividend payment, and the policies are designed around having a dividend payment. So they're not guaranteed to happen in the future. They're highly likely. I'm not allowed to say that they're guaranteed in the future. Now, there's a few things that you do want to keep in mind about the dividends, and that is as interest rates go up and down, the dividend rates also go up and down. So if it goes down, the dividends could be lower. If it goes up, the dividends could be higher. So it's definitely important to work with the right insurance company. You want a company that's highly rated, that's stable, that's proven that they've been able to maintain this consistent dividend over a very long period. We work with all of the best insurance companies in Canada doing this. Our net is not as wide as it is in the United States. In the United States, they have way more insurance companies they can choose from, but the ones that we do work with have been consistent at least for more than 100 years. Another thing you want to consider is the proper structuring, and you want to prevent any sort of tax or estate problems in the future. So you want to ensure that the policy is structured correctly, and that's super important to avoid unnecessary taxes. It's to avoid unnecessary fees, and that needs to be done up front when you set it up. It's tough to change these policies in the future if somebody doesn't do it properly. So one of the things you want to do, you want to name a contingent owner on the policy itself. This ensures a smooth transition if that grandparent or parent passes away before the transfer happens. You can use a family trust to hold the policy, and then this can also prevent any issues if you have minor beneficiaries because the trust now becomes in control. Something that's possible, but we would say use with extreme caution, is using irrevocable beneficiaries. So this protects the policy from misuse, and it ensures that the policy stays the exact way you wrote it, but it also removes a huge amount of flexibility and it really locks you in. So if you're ever going to use an irrevocable beneficiary, you want to be very careful and you want to be very, very sure of what you're doing. So as an example here, we'll say that a grandparent owns $1 million whole life insurance policy on the grandchild, and that the grandparent passes away without a contingent owner. So the policy then could go through probate and could potentially trigger estate tax. However, if it was properly structured, it could transfer immediately and tax-free to the contingent owner, which would probably be this child's parents, and continue through the next generation. Now, some final notes. This has been a long video, and I'm going to summarize here. The Rockefeller strategy is not just a method for preserving wealth, but it's a proven method for building multi-generational financial security that can apply today for Canadian families. By strategically leveraging the whole life insurance, your trust, your tax-efficient structuring, this approach ensures that the wealth is protected from unnecessary taxation, it's protected from market volatility, it's also protected from irresponsible financial decisions, right? Sometimes when you give money to kids, they don't make the best decisions. And so there's some protections built around that. Some people believe that intergenerational wealth building is reserved for the ultra rich. The truth is that this strategy is accessible to business owners, professionals, and families that are looking to create a long-term financial strategy, whether it's you want to protect your estate, whether you want to provide for your children or your grandchildren, you want to provide that financial security, or you want to create a self-sustaining wealth building system. The whole life insurance offers a solution to do this, right? It allows tax-free wealth transfer. It ensures that more of your hard-earned money stays in the family and less goes to CRA. It provides liquidity during the lifetime, and it gives you flexibility to fund things like education, real estate, businesses, weddings, cars, trips, whatever you want to pay for. It shields your estate from high CRA taxation. So it protects your family and your family's wealth from Ottawa coming in, taking half your money and saying, we know better how to spend this than you do. It can reduce your probate fees, and it can reduce your capital gains taxes by a lot. This also creates a financial system that your family can continue to build on for generations. Now, like any financial strategy, proper structuring is essential. So to maximize the benefits of the Rockefeller strategy, it's very important to set up the right ownership structure. It's important to have a contingent owner named on the policy. And you want to avoid working with somebody who doesn't do this all the time. You want to work with an expert who writes these policies all the time and knows how they work. They knows the ins and outs, how to get it done, where to place it, and how to do it. Now, if you're interested in putting something together like this, you want to protect your family and you want your family legacy to grow, talk to us. Message us on our website, safepacific.com. Fill out the contact form there. Somebody on the team will get back to you within 24 hours to set up a meeting time. And then from there, we'll figure out, we'll go through our discovery process, which is really to understand your current situation and to know what your goals and concerns are and figure out what's the best thing for you and your family to achieve your goals. Step 1. Go to our website and fill out the contact form. Now, if this Rockefeller method video, if you gain something from it today, please do all those things that the robots and the algorithms love, right? So hit like, hit subscribe, hit share, leave a comment below if you want to leave a comment. All of those things help these videos to go to more people that are just like you, because not a lot of people know that you can do this. Not a lot of people know how to do this. You now know how to do this. So hit those buttons so more people can learn about this and how to set up the Rockefeller method for themselves in Canada. That's it for me today. I will see you next time.